We should see those price pressures starting to wane a bit as we go into 2022. And that'll mean that some of the increased stress on household budgets should start to come back just a bit.
I'm Natalie Nanowski, and this is the Midweek Exchange, the show where we break down those big economic issues and explain how they could impact your life. As always, I'm joined by Brett House, Scotiabank's VP and Deputy Chief Economist. How are you doing today, Brett?
I'm doing well, though I'm feeling some price pressures rising in Canada.
And that's what I want to talk to you today about inflation. It is on the minds of many. We're seeing some of the highest numbers we've seen in the last 2 decades. What does this mean for the cost of living for the average Canadian?
Well, we did see a higher than expected inflation reading in the July numbers, where the year on year comparison came in at 3.7%. So that means the general price basket that we look at as an average consumption set for Canadians cost 3.7% more than it did a year ago. And that's a relatively big increase compared to the Bank of Canada's 2% target, but it's not entirely unexpected because a lot of that's catch up from the shutdowns that we had last year. We're going to expect to see some further catch up over the next few months ahead, but we should see those price pressures starting to wane a bit as we go into 2022. And that'll mean that some of the increased stress on household budgets should start to come back just a bit next year.
Now, staying on the topic of spending, we know that Canadians saved a lot during the pandemic, but now we're seeing that they are spending a lot too. Is the average Canadian household in a strong financial position to deal with these rising prices?
Well, speaking in average terms, because of course some households did far better than others through the pandemic, on average, Canadian households increased their savings markedly at the onset of the crisis in order to provide a bit of a cushion against the uncertainty that lay ahead. And now that we're reopening, those big savings cushions are being wound down, and we're seeing debt to income ratios creep back up again to the really high levels that we saw prior to the pandemic. But what's different now, again, on average, is that the cost of carrying those debt burdens has gone down a lot. Canadians have refinanced debt, shifted it from short-term consumer lending with relatively high interest rates into longer-term forms of borrowing, and refinanced their homes at much lower mortgage rates. And that's brought down the cost of carrying that debt burden. And so overall, even though debt levels aren't much lower than they were at the beginning of the pandemic, the cost of carrying that debt is cheaper, and that leaves a little more room in household budgets, again, on average, to deal with those higher prices that are starting to come through as we catch up from the last year and a half.
And as we move into fall, what should we be thinking about when it comes to debt and when it comes to inflation?
Well, in many respects, the summer's a bit of a funny time. We have, seasonal jobs that are related to the service sector as students and other people come back into the labor force. They tend to leave the job market in September. We also see teachers and other educational workers come back online. And so we're going through a bit of a reset in September, and we're going to be looking at the numbers as they come out to try to figure out where our path looks like it's going as we go into the autumn and into the winter. And that's going to be a big determinant of how quickly some of the exceptional support measures from government and from the Bank of Canada get pulled back further.
Okay, thanks so much, Brett.
Good to talk with you.
Good to talk with you too. And the Midweek Exchange will be back after a short break on September 22nd.